All right, let's talk about steel. It's easy to overlook, but it is, quite literally, the foundation of our modern world. I mean, think about it. The skyscrapers that define our cities, the cars that get us around, it's all built on steel. So today, we're going to break down this massive industry and figure out what really makes it tick, especially if you're looking at it from an investor's point of view.
And you know, that's not an exaggeration at all. Just take a second and look around you. The building you're in? It's almost certainly held up by a steel skeleton. The car you drive, your appliances, even the tiny paper clips on your desk. It is absolutely everywhere, which is why understanding the business of steel is so critical.
Now, to understand the steel market, you have to start here. Just look at that chart. China produces over half of the entire world's steel. 54%. That's more than every other country combined. India, you'll see, comes in at a very distant second, and this massive imbalance has a huge ripple effect on every single steel producer on the planet.
Because China's output is so enormous, they effectively set the global price for steel. And that means companies in India are what we call price takers. They can't just decide what they want to charge, they pretty much have to accept whatever the going rate is on the world market. So here's the key takeaway for an investor. In this business, profitability isn't about setting high prices. It's all about one thing: aggressively managing your costs.
Okay, so the global picture presents a challenge, no doubt. But this story within India's borders is where things get really exciting. There is a potential for a massive growth story brewing right here at home.
Just look at this gap. It's staggering. The world average for steel consumption is about 233 kilograms per person. In India, it's just 77. Now, you might see that as a weakness, but from an investment perspective, it's the exact opposite. That gap represents a massive runway for growth. As India develops, builds more roads, more buildings, more everything, that number is going to climb. And that means a huge surge in domestic demand for steel.
And the country is gearing up to meet that demand. The plan is to more than double India's steel production capacity by 2030, taking it from about 125 million tons per annum today to 300. This isn't just a small adjustment, it's a huge strategic push to power the country's growth from within.
So let's get back to that key idea. If you can't control the price you sell at, you have to control the price you buy at. For a commodity business like steel, managing the cost of your raw materials is everything. This is where the game is won or lost.
To make steel, you really need two primary ingredients: iron ore and something called coking coal. Now, you need a lot of both, but as we're about to see, one of them has a much bigger impact on a company's final cost sheet.
And there it is, crystal clear. Coking coal can be almost 3 times more expensive than iron ore. So what does that mean? It means that swings in the price of coking coal are going to have a way bigger impact on a steelmaker's bottom line. For any investor, this is a number you have to watch. The price of coking coal is a huge deal.
Now, here's where things get really interesting for India. On one hand, the country is sitting on massive reserves of high-quality iron ore. That is a fantastic strategic advantage. But, on the other hand, we have very little coking coal, so we're forced to import about 90% of what we need, mostly from places like Australia. And that creates a major vulnerability to global price hikes and supply chain disruptions.
So how do the smart companies fight back against this? The best strategy is called vertical integration. Simply put, it means owning your supply chain. Instead of buying your raw materials from the open market, you own the mines yourself. This gives you incredible control over your costs, and, just as importantly, it ensures you have a steady supply.
And here's a perfect real-world example of that. A company like Tata Steel meets all of its iron ore requirements from its very own mines. It's a huge advantage. It insulates them from price volatility. For an investor, that kind of control translates into more predictable costs and, hopefully, more stable profit margins. It's a powerful edge to have in a price-taker's world.
Okay, so we've got our raw materials sorted. Now, how do we actually turn all that stuff into steel? Well, it turns out there are 2 main paths a company can take, and they're really quite different from each other.
Path number 1 is a traditional, large-scale way. It's called the Basic Oxygen Furnace, or BOF route. This is heavy industry. You start with raw iron ore and coke, melt it all down in a massive blast furnace to get molten iron, and then you blast that with pure oxygen to refine it into steel. This is the model used by the giant, integrated steel plants.
Path number 2 is a totally different beast. It's the electric arc furnace, or EAF. And the crucial difference is it doesn't use iron ore at all. Its main input is recycled steel scrap.
You load up the furnace with scrap, zap it with a massive electric current to melt it down, and then you've got new steel. These are often called mini-mills.
So these two paths create very different kinds of businesses. The BOF guys are all about massive scale, starting from scratch. The EAF guys are all about recycling and flexibility, and this has big implications. EAF mini-mills are generally much better for the environment, and because they're smaller, they can be built closer to cities where there's plenty of scrap steel to collect. That can be a huge cost advantage.
So now we have a giant bucket of liquid steel, but you can't build a car or a fridge with that. The final crucial step is turning this molten metal into finished products, and this is where companies can really add value and seriously improve their profit margins.
You'll often hear about two processes, hot rolling and cold rolling. Hot rolling is for the basics. Think construction beams or simple frames where perfect precision isn't the top priority. It's cheaper to do. But cold rolling is a more refined process. It creates a stronger, smoother product that's used in things like car bodies and home appliances. This is what's called a value-added product. It costs more to make, sure, but it also sells for a lot more, and that means better margins for the company.
Okay, we've covered a ton of ground here, right? We've gone from the mines, through the furnaces, and to the finished product. So let's pull all this together into a simple, actionable checklist you can use whenever you're analyzing a steel company. Here it is, your 5-point checklist. First, check their vertical integration. How much control do they have over their raw material costs? Second, how reliant are they on imported coking coal? How much price risk are they exposed to? Third, what's their production method? Are they a giant BOF plant or a nimble EAF mini-mill? Fourth, look at their product mix. How much of their revenue comes from those high-margin, value-added products? And finally, number 5, the big picture. How are they positioned to take advantage of India's huge domestic growth story?
And that really brings us to the final question, doesn't it? All the pieces seem to be in place. You have a massive runway for domestic growth, you've got ambitious plans to expand capacity, and you have smart companies navigating this really complex market. So the question for every investor to think about is, how will all of these forces come together to forge the future of Indian steel? It's something to consider. Thanks so much for tuning in.